As I've said before, I think that we're likely to see an economic breakdown, and that will be followed by a political and social breakdown. I think the social political breakdown will come towards the end of this decade. And the reason I think it will happen is because if the economy breaks down, the welfare state will break down. If the welfare state breaks down, I think voters will say, right, the deal is off. We're not accepting the authority of the state. The state is there to provide the welfare state and to manage the economy. And I think people just won't accept government authority, and people will go a bit nuts. People will panic and get angry, and the state authority will go down. But the question is, for you might be interested, is one of the questions is, what can you invest in? What should people invest in order to protect themselves at that time, in order to prepare? Well, I've dealt with Bitcoin in previous videos. I look at other assets and see what they're like to invest in. Now, the first one is shares. I don't think shares are a good thing to invest in a time of economic and social breakdown, particularly not particularly now when share prices are at record highs. You just have to look at the S&P index or the Dow Jones, which I think is hovering just a bit below 31,000. That is a record high. There are loads of other measures you can use. I think one is the Case-Shiller index. One is the Case-Shiller index adjusted for profit margin. I think that's referred to as, I think, the Hussman index. I think that's what people call it. A good guide, I think, is margin debt, the amount of money that people have borrowed in order to buy shares, and that is at a record high. The reason I think that's a good measure is that is a historic measure. That was at a record high before the Great Depression, before the great crash of 1929. So what is margin debt doing at the moment? Well, it is at another record high. If I show you that, you can see that that red line there shows that margin debt, money borrowed in order to buy shares, that is at nearly $800 billion. Now, that is about 50% higher than it was before the housing crash of 2008. It's about almost twice what it was at the time of the internet boom, when you would think people were borrowing a lot of money just to get in on the internet boom. But you can also see how steep that line has got. A steep line like that, it does precede breakdowns, crashes. It preceded the breakdown of 2008, preceded the breakdown of 2000. My guess is it's not going to break down immediately. It'll probably go a bit further, might run another 5 years, but that is a sign that things are elevated. And if you get a social economic breakdown, share prices will fall, and I think they will fall hard. And market confidence is high. All it needs is for that market confidence to start falling, and then I think you will see people who have borrowed money in order to buy shares panicking and all running out of the door at the same time, which will cause share prices to fall very fast. Now, that little chart that I showed you there, that little chart, that is at a record high. That doesn't take account of what is happening at the moment, which is the government issuing stimulus checks to individuals under the Trump administration, and now under Biden issuing, I think, $1,400 to people who are out of work. And that money is what is getting invested via Robinhood into things like GameStop, the GameStop saga that's been going on. And I think that is borrowed money. It's not counted on the graphs as borrowed money. I think that is borrowed money. People out of work. Government gives them some money to support themselves. They're not going out and spending it in the supermarket. They think, what can I do with this? I will invest it in stocks and shares. I think that should be counted as margin debt. People are not investing it just because they can spare the money or afford to lose it. And so I think that adds to that margin debt bubble. It adds to the sensitivity of the stock market price. And if there's a correction, it will fall down fast. The reason why those stock prices, those share prices are so high is because debt levels have exploded. Governments have cut interest rates around the world very hard, down to zero. They've engaged, particularly the American government, has engaged in massive quantitative easing. That's when the central bank or the Federal Reserve prints money and then lends it, either lends it to big banks in the economy or lends it to the central government, who then spend it into the economy. That's stimulus checks, the stimmy checks that have been given to people by Trump and Joe Biden and then invested in companies like GameStop at ridiculously inflated prices. The Federal Reserve has pledged a week ago that it was going to keep rates low, interest rates low indefinitely, between 0 and 0.25%. It has said it's going to ignore the risks of inflation for now. It aims to have more than 2%. So if you have interest rates around 0 and inflation at 2%, that is a negative, effective negative interest rate. And they're also encouraging more financial stimulus, buying more mortgages from banks in America, and buying up more of their own bonds in America. And so, but there is a limited amount they can do with interest rates at 0 and debt levels skyrocketing. If share prices really start to fall, there aren't many tools that the central bank can use to try and rescue the situation like they did in 2008. And they are wrong to think they can push share prices up forever. If there's an economic breakdown, those shares will fall. So they're probably not a good thing to invest in times of economic breakdown. Okay, what about the next thing? Houses. Houses, surely they've got to be a good thing to invest in. Bricks and mortar houses are safe as houses. No, wrong answer. House buying is in pretty much, it's in another bubble, almost or pretty much in another all-time high. The number of housing transactions is not quite at an all-time high, but almost. If I show you another little chart, see that that blue line there, that blue line is the number of housing sales in the States, and you can see that just up there, it's about where it was in 2006, almost as high as it was at the all-time high in 2005. So it's nearly, and it's going up very sharply. I think that line will get above the all-time high in 2005. And that was the all-time high which preceded the housing and caused the housing crisis. So we're looking at levels of just numbers of transactions occurring that are greater than occurred just before the housing bust of 2008. What about housing prices? Well, I'll show you another little chart. Housing prices are at an all-time high. If I show you that, if you can see that, that blue line going up from about just before 1970, and it goes up and up and up. Again, before the housing bust of 2008, that is where the average house price stood, just a bit over about $245,000. Today, it's at nearly $347,000. That is an all-time high in average house prices. So if you have a massive number of sales at an all-time high in prices, that's what each residential unit gets sold for, you can say that's a housing bubble, and that is a hyper bubble in terms of housing. And the reason for it is very simple: money, cheap money getting lent into the economy, and the government is pushing that by getting the Central Bank of America to buy up mortgages. So the Federal Reserve, it goes to the banks that lend money to you for your mortgage, and it says to them, we will buy those mortgages off you. So the bank lends you money, next day the bank sells that mortgage to the American Federal Reserve. And so that is to encourage, to make those banks feel safe about lending money to more buyers. As more house buyers come along, it makes them feel safe about lending, and lending cheaply to house buyers. And probably what I guess must be happening is those banks must be looking at their mortgage books and saying, the mortgages we're going to sell to the Federal Reserve are the risky ones, the ones we don't want on our books. We can keep the safe ones, it's the unsafe ones we will sell to the Federal Reserve. So it is having a really strong artificial effect on the American housing market. Just, you want to buy a house, here's a mortgage, it's easy to get one. And that is why house prices are 1/3 higher than they were just before the 2008 housing bust. The only way that and if there is an economic crisis, the only thing governments can do is to reduce interest rates to make them go negative. So if you then take out a mortgage, the government pays you money every month. You don't pay interest to the bank every month. The central government via that bank pay you because you've borrowed that money. I can't see how it can go that far. So there aren't many tools they've got left. So if property prices start to go down, they're probably going to go down hard. So property is not a good thing to invest in times of economic breakdown. What about bonds, government debt? Well, again, what you have is governments buying up their own debt. So what happens is the central government, the American government, it needs money in order to finance welfare programs, in order to pay out stimulus checks. The way it does that is, one way is it lends money, it borrows money from banks and individuals out in the economy, and then it spends that money. So individual banks and individual investors buy a bond from the American government. They then can go and sell that bond to the American central bank, which is pretty much almost another branch of American government. So effectively there's kind of a closed loop. Government sells a bond to a bank, the bank then sells that bond to the Federal Reserve, and the Federal Reserve is buying up those bonds to the tune of $80 billion a month, and it's saying it might go higher, that it will continue to do at least that. And the result is that government bonds are at a very high elevated value. Interest rates are incredibly low, again targeted to be between 0 and 1/4%. Now that is a bubble. That is a bubble in government bonds. Now you can look at another. You don't have to look just at America. Look at France. I think France is a good example. The reason I think France is a good example is because you have people falling over themselves to lend money to the French government, even though the French government is bankrupt. The reason I know the French government is bankrupt is because a French minister said that the French government is bankrupt. They said it in 2013. The French jobs minister, he said there is a state in France, but it is a totally bankrupt state. And his handlers, his civil servants took him aside and said, we know France is broke, but you're not supposed to say that in a radio interview. So then you had a bunch of French ministers coming on and clarifying his remarks. I think the best clarification came from the finance minister, who the next day said, France is a really credible country. France is a country that is starting to recover. So he actually didn't say that France wasn't bankrupt. So I think what he meant was France is bankrupt. And how's the French recovery gone in the last 8 years since the French jobs minister said they were bankrupt in 2013? Not very well. So I think France is a bankrupt country. But people are falling over themselves to lend money to the French government. The reason I know that is because interest rates have gone negative in France, or interest rates on French 10-year bonds. So if you lend €100 to the French government, they don't, for 10 years, so €100, French government hold it for 10 years, they don't pay you back for 10 years, they don't pay you any interest, you pay them 30p or 30 cents per month, per year, for the privilege of lending to the French government. That is a bubble. I know that's a bubble because it's never happened before in the 250 years that France has been keeping records. The lowest that French interest rates have got is 1%, i.e. you lend €100 to the French government for 10 years, they pay you €1 a year in interest. That's the lowest it's ever got in history. Now it's so low that you pay 30p a year for the privilege of lending that €100 to the French state. So government bonds are not going to do well if there is an economic crisis or if there's a political breakdown and governments fall over, because it's effectively like lending money to a dead man, someone who no longer exists. No one does that. It's not a good idea. That won't help you if you lend money to the government in anticipation of economic collapse, economic breakdown. So one other thing you could look at is corporate bonds, lending money to businesses. Perhaps that will be a safe thing to do. Well, no, that won't be a safe thing to do. The yields on what's called junk bonds, i.e. non-blue chip companies, if they want to borrow from you, the interest rate that they pay is again at another all-time low. If I show you this chart, here's another one. That is the rate of interest on junk bonds. So lending money to non-blue chip companies in the States. You can see historically around between 1997, around 97, it was at about 10%. Then the recession of 2000, it went up to 12.5%. The government pumped in a load of money, and it went down to about 7%. And then you got the crash of 2008, and the interest rate that non-blue chip companies had to pay to on their debts went up to about 22%. And then the government pumped in a load of money, and it went down and down and down. And currently, the interest rate that those companies pay is about just over 4%. Okay, just over 4%, and that is a bubble. That has never been, nothing like that has been seen before. So that means that if the value of debt, money lent to American companies is at bubble levels, it won't do well if there's an economic and social breakdown. So that is unlikely to see you through. The common factor here is government, is money that has been lent into the economy by the American Central Bank, either lending it to big banks or lending it to the American government, which then spends it into the economy. And just so you see how much has been lent, that is in a bubble as well. It is no wonder it has created other bubbles. Going back to 1970, that blue line, that is the level of government debt in America. You see it forming, and the red line I've shown there, that is a nice parabolic exponential curve. Government debt is going exponential. I think it goes, if you look at that end, I think it probably goes more or less vertical in another 5 years' time, before about 2026. And so all of that money, that explains the bubbles or the elevated investment, the bubbles in bonds, in shares, and in housing prices. And if you get an economic breakdown, none of those things is going to do well. I think there is something else, all those prices have a long way to fall. There is something else that I think is necessary to consider, and that is historical sentiment. Investors, or big investors, big financiers, are hated with a passion at the moment. No one likes them. They've been hated since they got the bailout in 2008 because they are gambling. They are the high rollers in a rigged casino, and people resent that. And a measure of the resentment is the recent GameStop saga, where ordinary people getting, perhaps out of work, getting stimulus checks, are investing those stimulus checks in stocks, in companies like GameStop that are not very valuable, but investing them at very high rates simply in order to stick it to those big financiers, the big hedge funds, to try and hurt those big hedge funds. People are angry. People are willing to risk investing, pumping money into companies at massive overvalues simply in order to hurt those big investment funds. And what that's a measure of sentiment against the stock market, against Wall Street. That means if there is an economic and social breakdown, people will be averse and angry at the stock market, at Wall Street. That means people will not want to look at it, will not want to get in again. That happened after the crash of 1929. People got their fingers burnt. It took decades for people to trust banks enough just to deposit money in a bank, let alone to get into the share market. Even in the 1950s, ordinary Americans were still reluctant to get into the share market, even though it was the safest time probably in history, to invest in shares in America. Investors, when you get a social breakdown, it is the big financiers who are the first people to get strung up over lampposts. They get strung up over lampposts before politicians get strung up over lampposts. So if there's an economic and social breakdown, all those the investment assets that they specialise in, they are not likely to do well. They're likely to fall and remain low. So what is it that you can invest in order to try and protect yourselves to protect yourself in the case of economic breakdown? Things of practical, real, tangible value, not things of speculative value, not things that appear to have value simply because they add to the number of transactions. Things that have value that ordinary people can perceive. Things like food production, services that people need, whether or not there's an economic crisis, an economic breakdown. One way to get wealthy, if there's a social economic breakdown, is to be a bent left-wing civil servant who is close to the government land holdings department, or the government buildings department, or the government mining deposits department, mining rights department, because they do well, because government falls over, it has to sell off its assets, and the civil servants who are in charge of selling off those assets make a fortune in bribes. If you remember when the Soviet Union fell and the oligarchs snapped up the rights to snapped up Russia's oil reserves, they did it basically by getting close to ex-communist civil servants who did very nicely out of it. But the rest of us, what about the rest of us? Most of us are not bent psychopathic socialist civil servants. So the rest of us, we need to focus on things of practical, palpable value. Things that are despised now because they seem too lumpen. Those are the things that survive crashes. Land is a good one. It is at an elevated value now. It's not at bubble value. Land is good because it produces something of practical value that you know people are going to need. That is food. So land is something to look at. Precious metals, they're probably something good to look at because precious metals are despised at the moment. The speculators and big financiers really thoroughly dislike precious metals, probably because precious metals call out. They call time on the speculation bubble. It's actually quite difficult to... the speculation in precious metals tends to be fairly limited. That's why a gold standard, or gold is good as money, it tends to resist speculation in money or manipulation, the way that currencies get manipulated. And as a result, precious metals are a bit like the dowdy old Puritan walking in on an orgy and lecturing people about STDs. People don't want to hear that. They want to carry on with the orgy. They want to carry on with the investment orgy, the speculative orgy that's going on at the moment. But a lot of us don't have the money to invest in tracts of land or stashes of gold and silver. And so a really good thing you can invest in is in yourself, producing something of practical, tangible value. And what I would advise people to do, what I would advise you to do, is to look at businesses that are set up on an employee-owned basis, structured as employee-owned businesses. That might sound a very strange thing to do. I would understand if a lot of you think this is just slightly weird and that you don't really get it. My guess is, or my hope is, there are a few people who understand the rationality behind it and file it away for future use. The reason I think employee-owned businesses are likely to survive and do well in times of economic crisis and social breakdown is because a well thought out, a well structured employee-owned business works not on some technical solution, not on financial shenanigans, but on people's minds. And the power of the human mind, if it is nurtured and set free, is much greater, much stronger than any piece of technology or any financial shenanigan. And I can think of three ways in which it's much stronger. Firstly, it incentivizes the ordinary people on the ground doing the dirty jobs that make the money. It incentivizes them to be more productive because they are paid out of the profits. They take a share, they take a cut of the profits. So it's no longer simply a question of sucking up to the boss, getting a flat wage and hoping he's not watching if you want to goof off for half an hour. You have an incentive to be productive. Everyone does. It also means the second thing is it creates an incentive for people to work well together, because people are effectively working for each other because everyone is taking their pay out of the same profit bowl. It means that your colleague's performance is as important to your pay, was it is as important to your spouse and your family as your own performance at work. So it encourages people to coordinate and to cooperate, and that makes businesses a lot more, that will tend to make businesses more adaptive and resilient if you can make it work, because it will mean that people can work together to respond to changes, which you get a lot of if there is an economic and social breakdown. And the third reason is that the advantages, there are other advantages, but the third main one that I can see is that it is an advantage that existing businesses cannot adopt. And if you adopt, say, a clever piece of technology, another business, they'll find out about it, they can adopt it themselves. If you find a clever consultant, they can go and brief that clever consultant. If you buy a fancy piece of machinery, your rival can buy that same fancy piece of machinery. An existing business can probably do that better than you because they have good relationships, or better, they're likely to have better relationships with a bank, particularly if they're bigger than you. But what they can't do is an existing business cannot convert itself to an employee-owned structure. The reason they can't is because its existing employees won't tolerate it. That business will have to go to its existing employees and say, we want you to agree to change the terms of your contract. And those employees will say, no, we don't trust you. They will be in a different mindset. That is how the power of people's minds is so effective. If in existing businesses, the mindset will be turn up at 9, leave at 5, hate the boss, and don't trust the company in between. And so that means if you can do it, if you can set up a business on an employee-owned structure, you can chip away and undermine the pre-existing larger businesses year by year and drive them to the wall, because they will not be able to compete with that advantage that you have. They will not be able to adopt it. Now, it might not surprise you, I've written a guide and the legal documents that you can use if you want to set up an employee-owned company. It's free, I'll leave the link below. You can download those documents, you can use them, but all I say is it's at your own risk. Run them past your own lawyer first. You don't have to pay me any money for them. It might be interesting to look at, interesting to read. What I find fun about it is it's something that liberal left activists and politicians hate. They loathe and detest the idea of employee ownership because it's a way of encouraging equality without the intervention of the state. And socialist people, liberal lefties, they're not interested in equality. They say they are as a fig leaf for power grabs. They're interested in power. And if you can achieve and find a way to achieve greater equality without the involvement of the state, it drives them nuts. And that's what employee ownership tends to do. It does create a greater equality. There, as well as being an effective thing, I think it's a nicer thing. It creates greater freedom by setting free employees who are at the bottom of the pile. Normally, the boss won't trust them to organise their own working day. If they are incentivised by taking a share of the profits, that's how they get paid, you can give them more freedom, more discretion about how they work, about what they do during their day. That sets people free. That is a bit nicer. It gives people a bit more autonomy. It also makes working conditions a bit more friendly, a bit nicer between people, because everyone is working. People work for each other. That means you have an incentive to make sure your colleague is happy, because a happy colleague tends to be a productive colleague. So you will want to be nice to your colleagues. You will want to encourage a nice, mutually supportive culture at work. So it will encourage, as well as freedom, it will encourage friendship. And it will also encourage, the third thing it will encourage is greater fairness. It will tend to flatten that ownership curve. A successful employee-owned business will tend to spread ownership of the company, because a share in the hands of an employee will tend to be worth more, because it will motivate that employee to be more productive, to produce more effectively. So the extreme disparity, the extreme concentration of wealth and ownership that currently exists will tend to get wiped out by more efficient, more effective, more productive employee-owned businesses that have the incentive to spread ownership. That is a nice thing. That is greater fairness, reducing inequality, which liberal lefties can't stand. So it's probably not an easy thing to do, but if you can do it right, it is an effective thing to do, particularly in times of economic breakdown and social breakdown. It will enable you to survive, and if you do it right, it can enable you to survive and thrive before, during and after economic crisis and economic breakdown. Thank you.